Chris Marinac is Director of Research at Janney Montgomery Scott. Janney is one of those firms that kind of looks at these things, Chris, from a more holistic and detailed point of view. Kelly had a great question in this past segment about whether or not there are banks out there whose prospects are being foretold by their stock price, because it looks terrible for every single regional bank out there.
Well, I disagree with that narrative, and I disagree with a lot of the narratives that have come out, particularly the past 24 hours. I really think the banks are far better in terms of making money this quarter, tangible book value growing in the second quarter, and banks having higher liquidity today than they did in early March. So the idea that the stocks are foretelling something, I think, is incorrect. We have banks being used as weapons of destruction right now, and it's sad, it's disgusting, but it's where we are. And the information flow from the banks has been wide open. I think the information that PacWest and Western Alliance issued overnight was very helpful, and it's honest. And it's where these companies are. They're stable. Their deposits aren't running. Yet the short sale marketplace and negativity is driving the idea that there are going to be outflows happening. That hasn't happened. We did see outflows at First Republic. That was a very real point of wealth management clients buying treasuries and leaving the bank. That disintermediation actually happened, and it took the company down. It's a much different story at PacWest and Western Alliance. Those companies are far more stable in deposits than folks understand, and their capital levels are strong enough not only for them to survive, but to continue to work forward on their strategic plan. And PacWest had a game plan in place long before Silicon Valley was ever known to be a failing bank.
So Chris, I want to extend this conversation only because I was the one at CNBC staffed with covering Western Alliance Bank and PacWest and First Republic on earnings. I remember, First Republic aside, let's focus on PacWest and Western Alliance. I was the one who kind of went into the earnings reports, and I talked to people in the wake of them, and they all thought that the worst was over for PacWest and Western Alliance, and then we just saw the last 48 hours happen. How exactly then do you describe this, and is there a fear now that what we didn't think would happen to First Republic happened to First Republic? Could that also happen to a Western Alliance or a PacWest?
Well, sure, there's a fear, and I would say never. Anything is possible. I put it at less than 10% only because these companies have raised a lot of liquidity to handle uninsured depositors, to handle the surprises that are around the corner, and this clearly is a surprise. I think that depositors are a lot calmer than folks understand, and that's true for the entire industry, let alone Western Alliance and PacWest.
Chris, as we leave it here, people are trying to figure out, to the point we were just making, what's going to kind of contain this. Do you think raising the deposit cap, for instance, on transactional accounts, like Sheila Bair mentioned, would that even stop the problems at this point?
Well, the TAG program was put into place in November 2008. That worked out quite well. I think dusting it off and bringing it back would make sense. It certainly would give confidence on those transaction accounts. It did back then. I think the short sale ban that the SEC did in September 2008 should also be dusted off. That was helpful. It's unfortunate that we're here, but we are, and we really should consider changing gears, because it's really unfortunate to have the industry that provides credit and liquidity to businesses and households be damaged in this way.
I'll just say, there are those out there, Chris, who say a short ban will cause a near-term short squeeze or kind of a day or two of reprieve, but will do nothing in the long term. Is that right?
I disagree, because the fundamentals are way better. Banks have less leverage today. We're lending on 55, 60 cents on the dollar, where we were lending all day at 100 to 110 cents on the dollar in 2008. So the loss content is dramatically different today. There are losses in the banking industry. We have problems. Every bank needs to deal with them. But the earnings and cash flow that banks have can cover 500, 600 points of losses, which is plenty the next 2 years. So I think the banks can handle their own issues. And honestly, I think the marketplace just has not been reading the wide disclosures and the deep details that banks are giving, which is way better today than it was 15 years ago.